That means that the investors, the LP, would get 490, everything back, and they would have made a loss of 10 million, and you would get 0.
If you do not want to watch other people get rich and you being left behind, this is for you. Welcome to our masterclass about venture capital. Whether you are seeking an investment, maybe you want to work in venture capital, or just to become a brilliant investor, stay tuned. Today, we're going to talk about waterfall distribution, which is key if you want to know how the money is split and flowing within the venture capital. As always, we have our fantastic business lawyer, Kat, here to explain it.
Hello.
And we're going to give you concrete examples and very deep dive in a calculation. And you're going to get more information than you usually are getting in this episode.
Yeah, we're going to help you out.
We're going to really help you out. So let's start. The waterfall distribution. To begin with, what is it?
Good question.
Yes.
The waterfall distribution, that is when you invest in the VC fund, it in its turn invests in startups, then it exits those startups, get money back. But then when you have that profit, that result, what happens? Well, you need to distribute that money, right?
To the investors and
yourself.
Yeah.
Don't forget yourself.
I'm not.
So that's the waterfall. And that is typically or always made in 4 tiers, which means that the water will only trickle down from number 1 to number 2 if there is money left to go to step number 2, and then from number 2 to number 3 if there is money left to go to number 3, and then from number 3 to number 4 if there is money left. So if you only have money for step number 1 in the waterfall, the other things won't happen. And number 1, we'll go through them quickly and then we'll get back with a concrete example that will help you.
Yeah.
And like you said, we will in this example explain some variables that you typically do not hear about that is key to understanding the waterfall and the dynamics of how the venture capital firm will work with its committed capital and with its startup seeking quick exits, etc. So number 1 will be the return of capital. That means that the LPs, the investors, will need to get their monies back before any profit can be shared. Then number 2 will be the preferred return. That will be a hurdle rate where the LPs, the investors, get typically 8% return of capital before the venture capital manager gets to participate in the profit split. Then number 3 will be a catch-up for the venture capital manager, the GP. And that is because if all goes well and you come to the full carry mode, as it's called, then the manager is entitled to 20%, typically again, can of course vary, 20% of the profit. That means that they want to catch up that hurdle rate portion so that they get 20% of that hurdle rate amount plus their catch-up amount. And then when they have catched up, we go to number 4, which is full carry mode, which is a 80-20 split, where the investors get 80% and the manager, the GP, gets 20%. And we'll go through this. It will become much clearer when we deep dive into an example now. And we're going to use Ida.
Yes.
So Ida, you are the founder of Stellar Fund Management. You successfully raised 2 previous funds and now you're on fund number 3. And you have LPs that committed $500 million in this fund, right?
Yep.
So that is the assets under management in total, so to speak. We'll get back to that. And then after 8 years, when you close down the fund, you get a return of investment of $1.5 billion. So a 3x return. Yeah.
That's really good.
That's really good.
I'm satisfied.
Yeah. So you deployed 500 and you get 1,500,000,000 back. And now we're going to go through the waterfall together. So what was number 1? Do you remember?
Yep, that was the return on investment.
And how much capital do you have in investment?
500 million.
Yes. So step number 1, 500 of those, we'll call 1,500 now, just to make it simple, goes back to the investors. Step number 1, right? And then we check, do we still have capital enough so that the waterfall can go to step number 2? Yes.
Yes, it's 1,000 left.
Yeah. Let's say that instead, when you close the fund, you had 490 million back. Then we would take 490, the fund result, minus 500, the committed capital, and we would have a negative result of 10. That means that the investors, the LP, will get 490, everything back, and they would have made a loss of 10 million. And you, as the manager, the GP, will get 0, right?
Yes.
So the waterfall will stop. But in our case, we're happy.
Yes.
So we go to number 2, yeah, and that is the preferred return. Now the LPs want 8% compounded for the, let's say we had a 5-year fund, lifespan of 5 years. So they want 8% compounded over those 5 years back before you can get anything. So then we will simply do the calculation. 500 million US dollars times 1.08 for 8% for 5 years. And then we'll take that less the amount already received in step number 1, the 5 million. And that will leave us with approximately 235 million. So 235 million US dollars of that billion will, in step number 2, go back to the limited partners, the investors, which is not you, the GP.
No.
And for now, we're not talking about if the GP also has invested in the fund. So you might also be an LP, like a small portion, because typically the LPs want the GP to also invest.
Okay.
But then you are covered because you're part of the LP group. So in the second stage of the waterfall, the LP gets 235 million and the GP, the manager, still gets 0. Now we check, is there anything left for step number 3 in the waterfall, or do we stop here? Well,
We have left.
We have left. We take 1,500,000,000 US dollars, the fund result, minus 500 US dollars, return of capital, minus 235 million US dollars, the preferred return, and that means we have 765 million dollars left to distribute, right? So we go to step number 3.
Which is?
That is the catch-up.
Okay.
And we touched upon the carried interest being you, the fund manager, being entitled to 20% of all profits of the fund, right? That means that you are entitled to also have 20% of the hurdle rate portion, right? So it should be of all profits. So that's a bit complex. So in this catch-up phase, the distribution will disproportionately go to you as the GP, because you're going to catch up, because I already had some, right? So in this example, we're going to assume that you get 100% during the catch-up. But many LPs will demand that they get a portion of every extra dollar that is distributed from the fund. So instead of 100% going to the GP in the catch-up phase, it can be that 80% goes to the GP and 20% go to the LP, or 50-50. And what happens then? Well, the catch-up takes longer. Because for every extra dollar, you don't catch up directly. I also get some money back. So that means that you as the manager need to have reached a bigger and better result in total in order for you to get the full 20% of all profits. So let's jump back to Stellar Fund number 3 with the total profits was 1 billion, right? Yeah. And the preferred return already provided to the LPs was 235. And assuming a full catch-up, so 100% going to you, since the LPs have received 235 million, the GP should receive an amount ensuring that said amount is 20% of 235 million plus that amount. This means that the GP should receive 235 million divided by 0.8 with the result reduced by 235. That's equaling 58.75 million. And let's test this. Is 235 million 80% of 235 million plus 58 million.75? And 235 plus 58 million.75 times 0.8 equals 293.75 million US dollars.
That's
so
correct.
That is correct. Thank you, Ida. And just to help you out and illustrate this further so you really understand the catch-up, because typically I hear people just run over this in the explanation, so people don't really understand it. Let's look at an example. If Stellar Fund had a total profit after a return of capital of 250 million only, well, in this case, the LP would still get that hurdle rate, 235 million in the 8% return. But then the GP would only receive 250 million minus 235 million, equaling 15 million. So you would never reach a full catch-up, right? You would only have gotten 6% of the total profits. So that's why we have this in different steps in the waterfall, because it will kind of be your problem if we do not reach the full catch-up, not my problem as a LP. So I have a better deal in that sense. This is my money. Number 4, the full carry mode. In this step, we have the 80-20 split. So you will get full carry, the carried interest, the one that you are getting rich on. Because me as an LP, I'm typically an institutional investor or some other big corp perhaps. But you, as the fund manager, will most likely be one of a few team that gets huge amounts in your pocket. So waterfall step number 4. We had 1 billion, 1,000 million US dollars, we can say, minus 293.75 million US dollars. So we have, for the final step, 706.25 million US dollars left for the full carry mode. So we will split it simply. We will take 706.25 times 0.8, which means that there is 565 million to the LPs. And we will take 706.25 times 0.2, equaling 141.25 to you, the GP, in carried interest. And now let's just see the final result. The final result, the LP got, on top of return on capital, 235 plus 565, that's 800 million US dollars. And the GP got 58.75 plus 141.25, equaling 200 million US dollars. And if we're wondering, oh gosh, did we do this catch up correctly or not? Well, if we're wondering that, then we can simply check. The profit of the fund was
1 billion.
Yeah. And what's 80%? of 1 billion.
It's 800 million.
Yeah, and that's exactly what we got. And what's 20% of 1 million?
It's 200 million.
And that's what you get in carry, right?
Yes.
So we made it.
Really good. I mean, we made it all the 4 steps.
Yeah.
So it makes it profitable for everyone.
Yes. And we're going to share more insights, more deep dive for you, so you really know.
That's so good.
Yeah. One thing to know is that this 80-20 split, it can be up to a certain level where the LPs say that, well, if you reach that level, after that, perhaps, let's say the fund result is 2 billion. After that, we will go for a 70-30 split instead, or even a 50-50 split. So if the results are crazy good, you might even get more carry because you can layer it. So you can have how many steps you want in the waterfall, really.
Depending on if I did a good job or not.
Exactly. So if the results are, because I mean, then I might be super satisfied already with the catch-up and the hurdle rate and the profit split at step number 4. So if we reach even further, because the results are so big, I'm happy to give you more because you deserve it.
Yeah. Wow.
And one more thing, when we talked about that hurdle rate and the committed capital, we said that we took the 500 million times 8% hurdle rate for 5 years. A really important nuance for you to know is that the preferred return, that 8%, is only calculated on the capital that you have actually called upon, actually draw down and actually have under management.
Which means it's not the dry powder.
No, exactly. Which means that you as the VC, as the general partner of Stellar Fund number 3, will want to keep that period as short as ever possible. Because that will make it, you will better get quicker to the full carry mode, right?
Yeah.
Because it's less of a preferred return hurdle for you to get before you get to the catch-up and the full carry. And we can take an example. For example, imagine that instead of having all of the capital draw down on day number 1, which is very unrealistic, but that's just to make it simple, let's instead assume that the first 200 million is deployed in year 1 and exit is made after 3 years. And the remaining 300 million are deployed year 3 and exit is made after 2 years. And that's very plausible because it takes time to deal source, make the exit, etc. Then the preferred return in this case will be 200 million times 1.08 for 3 years minus 200 million, the return on capital, which is 129.9 million, and 300 million times 1.08 for 2 years minus 200 million. That's 41.6 million, which in total is 175.5 million. So compared to our first example, number 1, this means that there is a difference of more than $65 million for the hurdle rate. So again, why does this matter? Well, the GP, you will not get any profit sharing until all the preferred return has been paid out. So that's why you as the GP will typically aim to hold the startups and make an exit as quickly as possible. And that's good for any of you startups out there to know when we say that when you have VC money, the clock is ticking. It really is ticking. Because it's money not entering into their pockets, perhaps. If you get to full carry mode, it will still be the 80-20 split, so you're okay. But getting there.
Wow, this is such a great example. I'm blown away.
And if you want us to do a deep dive in either the carry, and also we're going to show you in the next episode how it's typically split. The carry is actually split between the partners in the GP. but also with the preferred return. And we're happy to do a deep dive to show you how it works with different portions in the committed capital. And also we can show you an example, a calculation example, where the catch-up is not full catch-up, 100%, like in this case.
Yeah, really good.
Where it's instead 80-20 or 50-50. So just drop a comment below if you want that. We'll
Yes,
help you.
and I do have a question, because this is like a mechanism to split the money. Is this standard procedure? You always do like this?
Yeah.
Typically?
Yeah, this is very standard procedure. What can differ is the numbers. I mean, the preferred return could be 5, it can be 12. The carry could be, I mean, if you're new in the game, you might say, I'll start with 10% carry until I reached a return of 200 million, because my fund is 50 million. And then after 200 million, I will take 20% carry. And then after 400 million, I will take 50% carry or something else. So the numbers can differ, but the structure, the waterfall structure with number 1, return on capital, number 2, a preferred return, number 3, a catch-up, and number 4, full carry mode, full profit split. That is very, very standard. And typically it is 80-20, the split.
Yeah, and I mean, it totally makes sense when you're describing it. So it sounds like a really good mechanism to have.
Because we want the same thing, right? But also, since it's my money, I want money back first.
Exactly.
And like we talk about, typically, the LPs will also require the GP to be an LP. So typically, they will say that I want 1 or 2% of the committed capital to come from your pocket. Because I do not want you to risk my money just to reach that high carry. Because, I mean, it doesn't matter. You have the management fee, so why not go crazy? I want you to kind of not sleep too well at night if the fund goes bad.
So it's a bit of a hook.
Yeah, indeed.
But is it common that the GP also acts as an LP?
Yeah, as I just said, it's typically a requirement.
Typically?
Yeah.
Okay.
Because we want you to have skin in the game.
That's really good.
Yeah. So if it's your first fund, you will typically need to have a loan, finance it in some way.
Good.
Yeah.
Well, thank you for explaining it so well. And now when you watch this, you know about the waterfall distribution.
And just drop any questions down below. We can make it even more complex. We can have an Excel spreadsheet if you want.
Yes, it's really interesting. Now you know about it, and really when people are talking about the waterfall distribution, you know exactly what they are talking about.
And our sponsor.
We have a sponsor. And this episode is powered by LE Fitness. Thank you for today. And as Kat said, if you have any questions, just drop them down below. And share this channel with your network. Like, subscribe, because we're going to keep doing this. Thank you.
Bye-bye.
Hej då.